All right, well, let's put all of this to work and get into some of your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so what we've learned from you, Meb, is you really embody or try to embody three principles: diversification, value, and trend following. And so each of your ETFs embody that either in totality or in one way or another. And so no surprise, they're your pro picks today. Your first one is the Cambria Shareholder Yield ETF. And this one looks to index toward companies that have a history of returning their free cash to shareholders. So what does that look like in the portfolio?
Yeah, so it's agnostic as to size. It's agnostic as to sectors. We cap the sectors. We don't want it being over a third, for example. But it will move anywhere, and it can own the really big stuff. It can own the really small stuff. SYLD in general right now is characterized as sort of a mid-cap fund, value fund. But it can shift, and it has over time. It owns 100 companies. The nice thing about this portfolio, and there's a lot of overlapping sort of Venn diagram opportunities, you're getting broad-based valuations at least half, and it doesn't even matter the metric you use: price earnings, price to book, price to sales. You guys can go throw any ETF ticker into Morningstar, and it'll give you a snapshot of what that portfolio owns over time. And the one thing, and you alluded to this slightly earlier, in the US, a lot of the tech companies are expensive, the stocks. So this fund has a very low tech weighting. It's mostly consumer discretionary, financials, materials, industrials, energy, those type of companies, kind of what you would think about when you think about companies that generate a ton of cash and then return it to shareholders. But interestingly enough, in foreign emerging, so EYLD for us, the same exact methodology but applied to emerging markets, one of the biggest sector weights is tech. And so it's not just that value avoids tech. It's just that when looking at the United States in particular, it's low weight tech. And it's the holistic aggregate of dividend buybacks. And so in the US, that's driven largely by buybacks. The average stock coming into the portfolio has a double-digit yield. And so let that sink in. The dividend yield on US stocks is like 1.5. And but most of the companies in the US lean really heavy into buybacks. And so the aggregate of that ends up being a lot more buyback focused. And foreign developed and emerging, and part of this is just because their markets have underperformed the US for 15 years. But they don't have as much of a culture of buybacks, but that's changing, and very quickly. We've seen it in Japan, we've seen it in UK, we're seeing it in China, where these companies are taking a totally different cultural approach to buybacks. That having been said, they still love their dividends. And so you see much higher dividend yields, 5%, 6% in these markets than you do in the US, but buybacks also. And so the holistic, again, tends to be double digits in these regions. And again, it's also important what you're avoiding. You're avoiding the really expensive, and you're avoiding the share issuers as well.
But then are you falling victim to, because this one has pulled back, are you falling victim to what's going on in the bond market? If there's a sell-off there and you can get a 5% dividend yield in bonds, are you kind of accidentally overweighting more bond proxies or interest rate sensitives with this ETF? Is that something you got to be mindful of?
You just opened a Pandora's box. So the speech I gave, it said 4 topics. I said, I'm going to tell you guys a warning, a solution to that warning, a head scratcher, and then something you've never heard of. The warning was broad-based U.S. stock market's expensive and now it's going down, which is not a warm and cozy place. The solution was anything other than market cap weight. So value and quality in the U.S., we like shareholder yield. Foreign and emerging markets, value there too. A global deep value approach, by the way, this year is up like 25%. So it is a massive, massive outperformance. Countries like Poland, et cetera, are just having a monster year. And then, but everyone knows U.S. stocks are expensive. Like you go on TV, look at Barron's, talk to everyone. Every quant shop understands that's well understood. What is the big head scratcher to me, and I could be wrong about everything we've talked about so far on this entire podcast, but the big head scratcher to me is fixed income market. If you go back to the last 100 years and look at average, riskier bonds usually yield more than less risky bonds. Like, that makes sense. Everyone would agree with that. However, over the past couple years, and we wrote another paper on this, common theme of this discussion is called T-bills and chill most of the time, where we said, you had this weird situation in the US where you had this inverted or negative yield curve, meaning longer duration, longer maturity bonds had lower yields or similar yields to things like T-bills. And historically, that doesn't make sense. Things like corporate bonds, junk bonds, emerging market debt, on and on, traditional riskier bonds didn't give you much yield spread relative to T-bills. That is still true today. And so we wrote a paper and said, does it make sense to invest in these risky bonds when they have a below average yield spread to T-bills? And the answer is no, it's a horrible idea. It's much better to invest when there's a margin of safety. It's very similar to stocks. You want to buy cheap stocks versus ones trading at 100 times revenue. And so, we launched a fund based on this topic that only invests in these bond markets when the spread gets wide enough. That fund is still 100% in cash. And so I said on Twitter, I said, everyone's freaking out, or they were, about bond yields going up on like the 10-year. I said, if T-bills are at 425, the historical 10 and 30 year should already be in the high fives, knocking on 6%. That's just for average. And I was like, a lot of these riskier bonds should be up near 7, 8, 9, 10%. And that's not even like blown out. That's just average. And so I don't think the world, and that has nothing to do with tariffs. It has nothing to do with anything else. It just has to do with this weird situation where many bond investors are not price sensitive. They went this long period of having no yield, and all of a sudden they're like, oh my gosh, I got 4% now. I can lock in my liabilities, but they're ignoring the fact that you could do that with just T-bills as opposed to taking on all this risk. So you could foresee a time or a situation, and historically corporate and junk has a high correlation to the VIX, which is a high correlation to just things hitting the fan and going crazy. You could foresee all these bond yields going crazy to the upside, in which case bonds go down. But also, as you mentioned and alluded to, very much could be a competitor for equities if you saw some of these bonds yielding 5, 6, 7, 8, 9, 10%.
Okay, so that kind of explains like what has hindered that performance. But you've also brought the Cambria Global Value ETF, and that one has done phenomenally well. And plays on that global value exposure. That one's up 24% already so far in 2025. So just elaborate a little bit more on what you're getting here and why it's doing well in this environment.
Well, let's be clear. It's done phenomenally well this year and phenomenally stinky for many years prior to that, at least on a relative basis to the U.S. Everything looks stinky relative to the U.S. This is actually, so in this paper on the bear market and diversification, this has arguably been the worst period in history for a diversified portfolio, and it doesn't even matter which one, relative to U.S. stocks in terms of absolute underperformance in years in a row. This is going back to 2009. The only comparable period would have been post-World War II. U.S. stocks, 15% a year, has just creamed everything else in the world. So global stocks, very famously, have underperformed. Doesn't matter which way you chop it up, foreign developed, foreign emerging. Our global value ETF buys the cheapest of the cheap. So it's considered a deep value fund. And it buys the cheapest third of global stock markets around the world. And so you end up with a PE ratio darn near around 10. And not surprisingly, this is long forgotten, abandoned. No one wants these. And but as you have seen this year, markets can kind of turn on a dime, and all of a sudden you blink and it's outperforming U.S. stocks by 30 percentage points or something. We think this could have a long way to go. Flows tend to really accentuate returns on both the upside and downside. But most of the investment meetings I've had over the past 5 years, you bring up particularly emerging markets, but many foreign markets, and people just shake their head. They're like, I don't want to hear it. Like long forgotten type of ideas. The average emerging market allocation in the U.S. is like 3%. So everyone's abandoned, forgotten them.
This ETF is super interesting because big index to, it looks like European banks. And like, when was the last time you heard people really go on about European banks, but they've been really quietly outperforming?
I think the European banks, there's a fun chart, I forget who it's from, showing European banks outperforming the Mag 7 over the last 3 years. So there's some of these forces at work that I think people don't pay attention to until they do, and then all of a sudden it becomes kind of the consensus. But we're definitely not there yet.
Okay, so your third one is the Trinity ETF, and that one's meant to, I think, capture all three of your investment styles, diversified, value, with the trend following piece. It's a little bit more like a yo-yo, this one. I'm just looking at the stock chart. What's kind of the ripe environment for this one?
Sure. So we write a lot about asset allocations, basically how to put it all together. We now have 4 asset allocation ETFs, meaning you could just put your whole portfolio in one fund and be done with it. I actually publish my investment allocation every couple of years. I'm due for a new one. I think the last one was 2022. And I basically put all my public assets into Trinity styles. And I'll tell you real quick what that is. If you buy a global asset allocation portfolio, and we have one called GAA, literally doesn't do anything. It buys a basket of global ETFs in stocks, bonds, real assets. It has some tilts towards value, but it's long only, it's buy and hold. That's a great portfolio. The Achilles heel of buy and hold historically has been the down times, the bad times, 2008, 2009. If you're an investor, you just have to sit there, sit on your hands, take it, as Bogle said, don't just do something, sit there, right? Like you just got to kind of withstand. And the problem with that is your investing portfolio has a high correlation to what's going on in the world. So just when everything is going down, your portfolio is going down too. And theoretically, that is not a great scenario. You're losing your job, companies are going under, Lehman's disappearing, everyone's uncertain, and you're losing money in your portfolio. And so trend following, to me, is the perfect antidote to that. Now, trend following traditionally does great in times of crisis. However, trend following is also hard because you look different. So 2010 to 2019, trend following, you would have looked way worse than your neighbor who is just dollar cost averaging into stocks or buy and hold or SPY. And so that's also hard. But as a complement, as a yin yang, those two fit together beautifully. Now, most investors don't have much of an allocation to trend, and our fund is GMOM. And so the combination of those two together is what we talk about as Trinity. Now, this is far more of a trend allocation than any other advisor I know in the world, or certainly professional investor. So this is half trend and half buy and hold. But the beauty of this is you always have one foot on each side. So think back to COVID pandemic, right? All of a sudden, it looked like the zombie apocalypse. And the trend stuff starts selling out of everything. You're sitting mostly in cash and bonds. And you're like, oh my God, this is going to be, the world's turning into The Last of Us or some of these crazy zombie movies. And then all of a sudden, you start to have treatments, things are fixing, markets, a lot of intervention, a lot of stimulus. And next thing you know, we're back at all times. You say, oh, thank God for buy and hold, because trend following would have underperformed coming out of that bounce. So it's a perfect psychological diversifier as well. So putting the two together, we think, is a great way to go about an allocation portfolio. And they tend to be much lower volatility than things like stocks.
Meb, this has been such a fascinating conversation. Thank you so much for joining us and sharing your insights about the markets.